Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on our last economy show of the year, how exciting is that we've made it this far. We're going to do our normal 5 segments. The show will be a little bit shorter just because, everyone's kind of wrapping up and there isn't as much to say that isn't repetitive at this point. So again, we always try to bring up new information and again, project forward. So what we're going to do today across our 5 segments, the first segment is what happens when global monetary policy tightens, because we're continuing to see some tightening. The UK just had a surprise rate hike. And what is that going to do for risk, and how are things going to shift? Then we're going to look at this Biden versus Manchin situation in Congress in terms of what is that doing for the Build Back Better bill or the infrastructure bill, and then what does that mean for some of the stimulus as we go into next year. And we're also seeing a shift in monetary and fiscal policy. What is that going to do on the monetary side as well as the fiscal side? And then what happens next year with supply chain bottlenecks? We're starting to see some of them alleviate a bit. What is that going to do to price? What is that going to do to wages? How is that going to adjust things? And then in Europe, prices surged to a new record when we look at the PPI. So we're going to talk about why is that a leading indicator for inflation and what does that mean for next year? And then what will China's monetary response be? Because there's a lot of back and forth as to they're going to ease, they're going to stay consistent. So again, we're going to weigh in on what we think based on some of the data sets that have come out so far. So now just getting right into it so that we can let everyone get started and have some food for and fodder for their Christmas meal. So here, when we're going to start with the global monetary conditions, and when you look at, shockingly, it's increased risk taking. So as we've seen an increase in risk taking, that has obviously driven up equity prices as people have looked to find ways, because by everyone's admission, out of every central bank out there, savings, if you leave your money in savings, you're going to miss out, especially with inflation the way it was going. So this has pushed people into commodities, into equities, into anything that they can to try to get a hold of some of these appreciations. Bitcoin, crypto in general is another. So when you look at real rates, as real rates have historically risen with equities until they reach a choking point. So when you look at what's becoming elevated, when you look at the risk profiles, that's typically when you start to see a reduction and there's a bit more of caution, and that's starting to play out. And in the next segment, we're going to look at how people are positioned, and you're starting to see a little bit of a move away from equities as people reposition their portfolios into year end and then setting things up for next year. But when you look at real policy rate, when you look at how it's been anchored at this negative level, that's why we expect, as monetary policy adjusts, we start to see these increases in rates. That's going to accelerate some of these down moves when you look at the stock to bond ratio. And it's really not going to be because we do expect bonds, bond yields to go up, but it's going to be more of a meet in the middle type situation where rates has been artificially low, and then obviously stocks artificially high, and that'll start to reverse, and we'll see that collapse coming to this pressure point as we get some of these risk adjustments. And the reason why that's going to happen is because when you look at what is happening in the economy overall, so when you look at global manufacturing PMI and growth tax indicators, so when we look at the growth profiles, things are rolling over. We've peaked out a bit, and now we're starting to see some of this compression closer to the long-term average trend, which is something that we think will play out over the next few months as we go into not only just next year, but also beyond. So then when you look at US ISM manufacturing PMI, you can see that how we see this having some of this downward pressure. And growth is just, again, pulling things back down. We've had some supply chain bottlenecks starting to alleviate a bit, and it's more on price. It's not so much, there's still pressure in the system. Inventories are still, historically low. So you're going to see some of these movements, but new orders are slowing. You have backlog that's increased a bit, but depending on where you are, at some places it's gotten a bit better. So you're starting to see a little bit of this normalizing nature when you look at the global manufacturing backdrop, which again will just pull this a bit further down. Now, on the other side, plans to shorten supply chains failed to materialize. Obviously, as you've seen, inventories adjust. So supply chain leaders had planned to make a plethora of adjustments starting in May of 2020, but many came up short with implementing. Unfortunate timing, given the pandemic caused by all of the bottlenecks. So there's still some adjustments that which is either nearshoring or onshoring, which just means of taking it closer to where it's going to be in the longer term, or bringing it back within your country. So some of these adjustments are going to continue. Your nearshoring and increasing supplier base, what was actually planned and what actually was implemented, obviously vastly different. So there's going to be some of these pieces that remain a focus, are going to continue to be deployed, and that's going to adjust how CapEx is spent, where some of the CapEx is being spent, to normalize some of these activities. And it's also another thing in terms of inflation. So when you look at it, how inflation has been that biggest driver for emerging market FX or foreign exchange in the second half of this year, we don't see that changing. Now, a lot of these countries are outside of Turkey are trying to get in front of it. So they're trying to get in front of inflation. They're raising rates. They're trying to be cautious, pulling some of this liquidity out, where Turkey, on the other hand, is now stepping in to try to support the lira, because Erdogan has essentially said that he is going to continue to cut rates and eventually inflation will get better. I can be the first to tell him that is not how inflation works, but it's going to be an interesting thought experiment and how it plays out. But you can see just where headline inflation is and why it's so important to get in front of it. Now, as the U.S. accelerates tapering and you start to see some pressure on the 10-year moving back up, that'll also put more pressure on borrowing in these countries. And it's why they're trying to purchase dollars. They're trying to get in front of and make sure that they have enough stability in their currencies for when this reverses. Now, there are two examples of countries that haven't. So when you look at the U.S. dollar versus the Argentine peso, and this is the informal rate, so this is the black market, you can see just how elevated things have gotten. And now when you look at the U.S. dollar versus the lira, the central bank has stepped in trying to support it, creating this big rally. But as we know, anytime a central bank steps in to try to protect something, the market just looks at this as a test of when will they give up, and they'll continue to press until finally the central bank says, we don't have the capacity anymore, we have to yield, and this will send it essentially cascading down again. It'll just be a matter of time as to when that happens. Now, when you look at how people are going to adjust for 2022, so this is looking at people that expect, respondents were asked when they expect that they will next take a leisure trip. And it's interesting because when you look at Japan, 23% said never, and then 29% said more than a year. So I think when you look at even the US, China, Germany, a lot of these countries are saying when you look at next year as an event, almost 50% say that they're not traveling in the next 6 months. And I think that's when you start looking at some of the shifts, how this is moving. When you average it in general in terms of what they're going to be doing, the purpose of leisure travel and what that will be for in terms of relax, when you spend time with family to escape or get away. But then when you look at to spend time on my own, that's to collapsing, to check on, to experience luxury, to attend a specific event. A lot of these event-driven things are dropping down. And I think it's going to be interesting to see how much is this because of Omicron, and then as that fades, as they all do you get a bit more activity? Because when you look at Canada, for an example, 35% said more than a year. Now, how much of this is Omicron versus how much of this is, well, my wages haven't really gone up. I've already spent a lot of my savings, so I need to replenish. I think there's a lot more than just COVID right now. And I know that that's hard to separate because all we hear about is COVID, coronavirus, but the economy hasn't really gone down all that much because of coronavirus. Or I should say at least recently. And this is, I think, more about what is just beneath the surface of spending, wages, income levels, savings levels. And I think this is where a lot of this discretion, if you have more discretionary income, this isn't like, oh, I'm going to go to a nicer dinner tonight. This is, I'm going to spend a couple $1,000s to go travel. And you're seeing this hesitancy, and I don't really think it's a COVID thing, and it's more of the inflation side and just where costs shake out. But while all of this is happening and how the market is changing in general, green bonds continue to price tighter in the primary market. New issued concession green bonds at 3.7% in 2021. New issued concession excluding green bonds at 7.5%. Again, green bonds still remain the favorite spot because there aren't as many. It still remains a fairly robust place to try to issue bonds. Now, when you look at flows into sustainable strategies, my private equity fund, we do have one, and it's not so much 100% renewable, but it is on a sustainable track in terms of hydro dams, other forms of base load capacity, and some renewable / organic fertilizers. So you can see it remains a focal point in 2020, and we don't see that changing as it continues to be a focal point into 2021 and beyond. Work hours decline. I think this is interesting to see what caused it. So when you look at average working hours, they actually went up in the U.S., and that's really because we had a big decline in the participation rate, which meant that just more people those who were working had to carry more hours. But then when you look at other areas, the average working hours came down. And that's because you had a shift in participation rate. And you can see in the U.S., the participation rate and the unemployment rate had that huge drop. Where in working hours, when you look at just how some of these are structured, a lot of them have unions, or they, you need government approval to let people go. So that's because that just ended up, you reduced average working hours around the world in terms of how they're structured. So the labor force participation rate came down a bit, but you can see the unemployment rate wasn't that biggest drop. And instead, you had just people, instead of working 40 hours a week, you worked 15 or 17, where you, in the U.S., just based on this chart, you either got let go or you were, you shouldn't say either, you were let go. And then you asked others to do more. And that's an interesting kind of backdrop of how people are slightly different and how countries enacted and looked at ways to adjust to COVID as a whole. But they've had a very similar recovery. So it's not that one is better or worse, because you're starting to see them come back. And now, and we'll go through this in segments 2 and 3, in terms of where is participation rate and where is the slack in the economy. And you can see that they still exist, and that's because we're not getting back to that participation rate due to early retirements and people still either unwilling or not wanting to come back to the market. So then when you look at year-to-date numbers, I think this is interesting. I just had to fly to California, and the amount of unruly passengers, and I think this is just showing how civility died with when COVID lockdown started. But when you look at investigations initiated for calendar year going back to 1995 and where we are today, you get an idea of just how insane people have gotten and how divided the country and really this is just in general on how people are taking their stance, and it really starts from the top, and we have to find ways to really show that look, we have difference of opinions, but there's ways to negotiate for them and to have differences while still respecting someone else's opinion. And that's when it's interesting, because then you look at about 1 in 5 Americans say life in their community will never return to how it was before the pandemic. And I think this is more because people have become so divided in their opinions and their ideas. Now, I have very strong opinions, but I always like a conversation. I like positive discourse. I like to hear what someone else thinks. And again, everyone thinks differently. You're going to see a problem and you're going to have a different way to address it. And that's okay. And listening to people, hearing them talk it out is how you can refine your view and your opinion and really come at a situation in the best way possible. And so I think this is something where then you round it out of why. Well, nearly half of Americans say the pandemic has divided their community. And when you look at what it's done, as people were already going more introvert with social media, the way people interacted with individuals, it's easy to be a keyboard warrior. It's easier to sit there and type mean things in comments, or, I'm going to blast out a mean tweet. But when you have to say that to someone's face, you look them in the eye, you're not going to be as aggressive. You're going to soften it up a bit. You're going to be a bit more, you're just going to try to have a dialogue instead of just being so abrupt. And I think as we come back into society, this will change. You'll get people, but we have to get people back into society. We have to get people in, and this is, I've had these conversations with my father in the past where we really need clubs, and as adults, again, going through school, you're in sports, you're in clubs, you're in this, but then that dies away. And in previous years, it used to be the church or the Rotary Club or the Freemasons, or, pick your poison in terms of, some sort of adult club where, because let's be fair, it's harder to make friends as you get older. You're not forced to meet new people. How often, yes, when you change jobs, you're going to have to meet new people, but how often do you do that? Where every year you're going from grade 1 to grade 2, grade 2 to grade 3, people were coming in and out of school. You were starting a new sport, you were starting in a new league. So as a child, you're always forced outside your shell to meet new people. And we've lost that. And I think that's something where we really need to find ways to get more involved in the community and not just sit at home and bang out, fire tweets or memes or whatever, LinkedIn posts. And I think that will help alleviate some of this, but it'll take time, and hopefully we get there as we get to the other side of coronavirus. So now that we went through that, now we want to look at, on the U.S. side, looking at monetary and fiscal policy and really how things are shaping up as we go into 2022.